modern money theory tries to do is to explain how the monetary system as it exists now and as it existed in the past actually operates. And I guess the thing that shocks people most about modern money theory is that we say that a sovereign country that issues its own currency cannot run out of money. And so when your elected representatives, in my case, President Obama, says we would love to do more to help the economy grow and to resolve the unemployment problem, the problem is that the government ran out of money. We know that that's false. Sovereign governments issue their own currencies. Nowadays, it's mostly through keystrokes. In the past, it was they actually printed up money, paper money, or they stamped coins, or they sent out checks, which lead to credits to bank deposits. Now, the crediting to bank deposits is done through keystrokes, as Chairman Bernanke said in Congress, and you cannot run out of keystrokes. That doesn't mean you should spend without limit. What it says is the limit is not the amount of money. The limit is the resources that are available for the government to purchase and the labor resources that are available for the government to hire. So you can run up against a full employment constraint. You can cause inflation by spending too much, but you can't run out of money. Most politicians and many economists start from the assumption that governments are like households or like firms, and they face a budget constraint. The budget constraint is determined by their income, and for the government this is said to be tax revenue, and their ability to borrow, and that is, in the case of the government, issuing bonds to markets. So they view the government as being constrained in a way that's very similar to households. So we hear all the time in America, and you probably hear it too in Spain, politicians saying, well, if I ran my if I ran my household the way that the government is running its budget, I would go bankrupt, which is true. But governments are not like households. More technically, anyone who studied economics was introduced to the money supply through something called the deposit multiplier expansion process. And in that, private bank money creation is supposed to be limited by bank reserves. And since the central bank supplies bank reserves, there's a belief that the central bank controls the private creation of money. And we argue that that is a misunderstanding of the way that banks operate. So we argue there are problems with the way they present government spending and also problems with the way they present government control over bank creation of money. In both cases, orthodoxy has it wrong. So very simply, the way that banks operate is they sit there and they wait for a good customer to come in. If the customer seems to be creditworthy and the customer wants a bank loan in order to spend, maybe to buy a car, maybe to buy a house, the bank, after doing what we call credit underwriting, which is basically assessing creditworthiness, the bank will create money in the form of a demand deposit at the bank by accepting a loan. So what endogenous money says is that loans create deposits, not in some metaphysical sense, but in the sense that if you have a willing borrower and a willing banker, the banker creates demand deposits that are used as money by the borrowers to go buy the car or go buy the house. Look, we hope that the financial system serves at least some public purpose. We want it to serve a private purpose too, but just enriching the top management of the financial institutions is not serving a public purpose. In fact, it probably is operating against the public purpose because it's concentrating income and wealth in the hands of a few. So the top 1%, the top tenth of 1%, the concentration of income in the hands of people who control the financial system has been a major contributor to the increased concentration of income and wealth at the very, very top of the income distribution. So what we need to do is to redirect finance toward at least serving in part a public purpose, which is basically getting credit into the hands of those who are going to increase the productivity of the economy, to increase the standard of living. In addition, of course, the private financial system plays some role in government finance too, because we have governments that are selling bonds into the financial system. And what we have found in the aftermath of the global financial crisis and all the scandals that have come to light is that the private financial system has actually been rigging the bond markets. Now, that is rigging the interest rates that are charged on government debt. These sorts of things should not be permitted. They're against the public interest. Well, first we start out by identifying the purposes of a financial system, and we can identify a half dozen functions that we need the financial system to provide. And right now, well, over the past 30 or 40 years, maybe even a little bit longer, we've come to view the private financial system as having sort of a monopoly on this. We have reduced the role for the public sector to play in providing financial services. Just as one example, it used to be extremely common to have postal savings banks. Postal savings banks were government, public institutions that provided some of the financial services that a modern economy needs. Savings deposits, for example, and payment services that were provided very cheaply to everybody, all the residents of a nation. Those have mostly disappeared. In the United States, ours disappeared in the mid-60s. I'm not sure if Italy still has theirs, but Italy used to have a very strong postal savings system. It's just an example of something that can be done, a safe and secure way to make your payments and also to save and earn a little bit of interest. Instead, we've sort of given all of the functions to the private financial institutions, and we've allowed them to consolidate them in these sort of big box, huge financial institutions. In the United States, we have 2 or 3 financial institutions that have well over $2 trillion of assets, maybe up to $5 trillion, depending on how which you want to count, because they have a lot of stuff off their balance sheets. You move it all in. So institutions that are $4 or $5 trillion that provide a full range of financial services and don't do any of them very well. Why do we allow this? So what I think we should do is break up the biggest banks. Well, I think the development banks, public development banks, are a very good idea because the private financial sector has not done a very good job of financing development. Brazil has a big public development bank, and it is providing a lot of the finance for the development of the Brazilian economy. I think that this is something that countries ought to look at. Get the government involved in promoting the development of the economy. As far as the euro goes, the crisis could easily be seen coming in the 1990s. The setup, we say the euro was fatally flawed. It is unsustainable. It will not survive. Exactly when that will be realized, and nations will either abandon the euro or the euro will be reformed, I don't know. We're sort of stumbling through now with very reluctant help provided by the center to the countries on the periphery with problems. But the problem is not the behavior of the individual nations. It is not that the Greeks spend too much. The problem is with the setup of the euro. I said that modern money theory studies how sort of money works, and the sovereign currency system goes back 4,000 years or so. The euro was a major deviation from the way it's ever been done before. It was an experiment. It was a grand experiment, the biggest experiment that's ever been undertaken. And we know that it was, the design was flawed and inevitably would lead to a crisis, and we've seen it lead to a crisis. This is not, looking with the perspective of history. We said this from the very beginning, from the early 90s. Okay, so should some country leave? Well, I'm not going to make a recommendation one way or the other. What I'm saying is that either you have to have reform or you must break up the euro. I'm hopeful that you can reform the euro because economically it's not difficult at all to see, at least from a modern money perspective, what you need to do. It's actually economically simple, okay? Leaving the euro is also simple. It's simple to see what you will do. You will reinstate your own sovereign currency. You will solve the fiscal problem. You'll be able to spend as much as you need to get to full employment. You won't need to worry about current account imbalances the way that you have to worry about them when you're in the euro. You'll be able to run budget deficits and current account deficits as necessary. It's the constraints of the euro that make it impossible for you to run a continued current account deficit and a continued budget deficit. So once you leave the euro, you'll be okay. The problem of either staying in or of leaving, the problems are all political. Okay, so I'm not a political scientist. It would seem to me this is not too hard. You get people in the room, you bang their heads together, and you resolve this. But of course, that is not happening. Okay, there are at least two major ways, different ways to do it. One is that you adopt the U.S. model. What is the U.S. model? It's a dollar union. We have 50 states, 50 members of a dollar union. We have Washington that has a budget of 25% of GDP. Our states run current account deficits with each other. We don't worry about it. Okay, it doesn't matter. Why? Because there are fiscal transfers from Washington to the states that run current account deficits so that their unemployment rate doesn't shoot up to 50%, like Spanish youth unemployment. So fiscal transfers are the way. The European Parliament has a budget that's much less than 1% of Euroland GDP. It's not enough. There are fiscal transfers, but they're much too small to resolve the problems. So one solution is give the European Parliament a reasonable budget. What the number is, I don't know, but it's going to be bigger than 10% of GDP, and redistribute. Right now it would be to the periphery nations for the most part. And stop worrying so much about the current account deficits, okay? And budget deficits, because the spending would come from them, not from your own individual treasury. The other is you can do it through the ECB. The ECB could stand ready to buy, let's say, debt equal to 60% of GDP, which is the Maastricht criteria. They will buy up to 60% and guarantee a very low interest rate. It should be below your growth rate. And since Euroland grows very slow, it's going to have to be a very low interest rate. Interest rates above the growth rate always lead to debt problems. So you get the interest rate below the growth rate, and they buy 60%. If you want to run bigger deficit than that, then you go to the markets. Okay, so the central bank first buys 60%. So every year you can issue more debt to keep your ratio at 60%, and the ECB guarantees that they will buy that at a decent interest rate.
Entonces,
let me just say first that expansionary austerity is complete nonsense. At best, you could push the problems onto another member nation, at the very best. If you became the lowest cost producer, you wipe out your labor unions, you reduce wages to rock bottom levels, you might be able to outcompete another member nation. All you've done is push the problem over there. It doesn't resolve the problem within the EMU. So the way out is that you need more spending. Unemployment is evidence that spending is too low, and the unemployment rates are completely unacceptable in most member nations. The only member nations that have unemployment rates that might be considered reasonable are the major exporters. For every country that runs a current account surplus, there has to be somebody that's running a current account deficit. They're the ones with very high unemployment rates. So the only solution is to spend more. The individual member nations cannot spend more, so it has to come from the center. On debt restructuring, could be a good idea. It pushes the problem a little bit farther into the future. It doesn't resolve any of the fundamental problems of the euro. So it can't possibly be a solution. It could be a temporary holding pattern and say give more time to think about how you're going to reform the euro, but you have to reform the euro. Yeah, reducing the debt burden, you can do that by lowering the interest rates or by stretching out the payments. Again, it doesn't resolve anything because the way it's set up, some countries are going to run big budget deficits. If you run a current account deficit, it's going to be mostly against Germany. You run a current account deficit against Germany. To allow your private sector to avoid a deficit, you must have a budget deficit. Okay? Either the private sector has to run deficits. We've seen what kind of problem that causes. That was the trigger for the global financial crisis. The deficits of the Spanish private sector and the American private sector really is what caused and the Irish, is what caused the problems. Neither the Spanish nor the Irish were running budget deficits. They were running private sector deficits until the debt built up enough that it led to a debt crisis in the private sector. Governments tried to bail them out. My point is, if you're running a current account deficit, one of your other sectors has to be running a deficit, either your government or your households and firms. Households and firm deficits lead to financial crises. Okay, budget deficits are okay in the case of the United States because we have our own currency. All right? They're not okay in the case of members of the EMU, because you gave up your currency. So something has to give if you have a system in which current account deficits are not sustainable because the government cannot run a sustained budget deficit. Yeah, I think Japan would be your best case scenario. I don't think that you could manage to do as well as Japan. I think that could be a U.S. scenario. If the U.S. government refuses to spend enough or give enough tax relief, Japan could be our scenario. And we followed the Japanese scenario fairly well until recently. It looks like we might finally be recovering. I'm still skeptical that it's sustainable. But we actually were following the Japanese scenario. We were even using the same policies, quantitative easing. But no, I don't think Europe can do that. I think the fiscal constraints are too tough. The Japanese debt to GDP ratio is 250%. You guys can't do that. So no, that's not going to happen. Maybe Germany could do that one, but you can't do that one. I agree with that. It's not only leading to economic problems, it's leading to severe political problems. I think has given a bit of support to the far right wing, fascist parties who are stronger on the necessity of getting out of this. And Syriza gave an opening. Here's an alternative. Here is a progressive path to trying to resolve this problem, and just completely rejecting what they're proposing and saying that you need more structural reform, which can't possibly work. There may be structural problems in Greece, and it seems like there are, and it seems like Syriza is willing to address those, but to say that you must do those as a condition of getting any kind of financial help, I think is the wrong way to go. Let's solve the financial problems, let's reform the euro system, and let's address the structural problems. But that's going to take time. You cannot have the kind of structural reforms they're talking about in 4 months. This will require probably some years, and Greece doesn't have some years to deal with these.